What's going on, everybody, and welcome back to yet another video. In today's video, I'm going to be sharing with you guys one strategy that you can start using right away to get yourself funded. This is a strategy that I have not taught on my channel yet, so make sure you guys pay attention. And real quick, as always, if you guys do find value, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But without further ado, let's hop into the video. And I do want to say that my boy GD Investments did teach me this strategy, and this is easily becoming one of my favorite intraday day trading strategies. So shout out to him. And if you guys want to check him out, I'll be leaving his YouTube down in the description. But there are three different components that we need to look for this setup. The first one being the pre-market highs and lows. So what I mean by pre-market highs and lows is anything after the market closed the previous day and the open of the current day. So here's the close of yesterday, and then here is the open of today at 9:30 a.m. So anything in between this range, what I want to do is find the highest point of price action and the lowest point of price action. From there, what I want to do is I want to mark that pre-market high and I want to mark that pre-market low. So if we're looking at the S&P 500 futures, here's our high and here's our low. Now, once we end up breaking that pre-market high or pre-market low, the second thing that we want to look for is a fair value gap. Now, I've gotten asked quite often, what is a fair value gap? So there are two different kinds of fair value gaps. First, we have a bullish fair value gap. This is going to be a 3-candle formation. And the first candle, what we're looking for is for that to be a smaller candle. Now, the candle that's most important is going to be that second candle because it needs to make a large aggressive move away from that first candle. And then after that, we need to identify the third candle and make sure that the third candle's low does not intersect with the first candle's high. And then from there, what you're going to do is you're going to draw from the high of that first candle to the low of that third candle, and that's going to create your fair value gap. So this is considered a bullish fair value gap. Now, had this third candle's wick came down and touched the high of this first candle right here, that would not be considered a fair value gap. Again, we need to have that small first candle, a large aggressive move away from that first candle, and then the third candle, as long as it doesn't intersect with this high right here, is considered a fair value gap. And we even have more over here. So looking at this one right here, first one, small green candle, second candle, large aggressive move away, third candle does not intersect with the high of that first candle. And what do we notice? Price retraces into the fair value gap, makes it support, and makes a move up. And then here's just one more example. We have our small green candle, large aggressive move away. We can take the high of that first candle to the low of the third candle, retraces back into the fair value gap, makes it support, and then it makes the move up. So those are going to be your bullish fair value gaps. Now on the flip side, we also have our bearish fair value gaps. So again, what we're going to be looking for is a small first candle, and then the second candle needs to be a large aggressive move away from that first candle. Now with the third candle, all we have to do is make sure that the upper wick does not intersect with the low of that first candle. Now, something I forgot to mention, it doesn't matter if this first candle is red or green, and it doesn't matter if this third candle is red or green. The only thing that's important is that the second candle is a very large move away in the opposite direction. So again, this candle could be red, this candle could be red, but as long as this one is green, we have that fair value gap. And then vice versa, this candle could be green, this candle could be green, but what's important is that this second one is red and it's a large aggressive move away. So because we have that first candle here, large aggressive sell off to the downside, and that third candle does not intersect with the low of that first candle, this is going to be our fair value gap right there. Again, this is a bearish fair value gap. Here's another bearish fair value gap right here. And then we even had one that I traded today on NQ, and it was the exact strategy that I'm going to be showing you guys. But as we can see, we have this large aggressive sell-off to the downside. Third candle high doesn't intersect with that first candle low. And as a result, it creates a fair value gap. Now, when trading with these fair value gaps, it's not as easy as just going short because price goes into it or going long just because price goes into it. We need to look for more confirmation. So the third thing that I do, and it's actually a mixture of two different things, is first, I like to add the 8 EMA because I've noticed that using that 8 EMA, if you can find confluence with it inside of the fair value gap, it actually gives more confluence and more confidence to the trader to take a position. So I like to add that 8 EMA for a little more added confirmation and for it to tell me like where inside of this fair value gap should I be looking to go short, because I mean, looking at this, it's a pretty large fair value gap. So we don't want to just go short because it goes into it. This gives us a more direct area that we should watch. And then the second tool that I like to use is actually my Fibonacci retracement. And I measure from this low point right here to this high point right here, or vice versa if we're looking at a bullish fair value gap. So I'll look at that 50 and 61.8 inside of the fair value gap. And what I really like is when that 8 EMA lines up with that 50 and 61.8 inside of the fair value gap. So those are the three things that I am going to be looking for this strategy. Now, the trade that I ended up taking today, if we're looking at NQ and we're looking at the pre-market data, we can see that we set our pre-market low right here. So let's actually just use this replay mode, because this is exactly what I was watching when taking this trade today. Again, this is the three criteria that we are looking for. We have our pre-market low. From there, I am looking for price to break that pre-market low, or if it's a bullish example, we're looking for it to break above that pre-market high, create a fair value gap, which we created right here. Again, here's our low point. Here's our high point, and we have our 8 EMA to give us a more direct area to watch inside of that fair value gap. But then also we have the Fibonacci retracement right here. So this is telling us if we're going to be looking for a reject, our ideal area to watch is going to be anywhere from this pre-market low up into this 8 EMA. So now if we go forward, we can see that price does push into that pre-market low. However, there's no confluence to go short yet. And then from there, you can see that price push straight into that 8 EMA and that 50% retracement between these two candles right there, and confirmed a short entry. So because the risk is so tight, and if you broke it down to a smaller time frame and identified a sniper entry, your stop loss in this scenario, you have two different ways that you could go about it. You could either keep a stop right above that 8 EMA if we started to show strength above it, or you could have a little wider of a stop right above that fair value gap right there. So even if you got an entry, let's just put it a little lower right there. Based off of this one candle right here, you are already at a 2R trade, meaning you are risking $1 to make $2 back. And again, I personally ended up taking this trade on QQQ options, and I was able to profit a 40% return on this one candle right here. And then here's a bullish example right here. Going into the morning, this was our pre-market high before the market opened. Therefore, I would be marking this high point right here. Price immediately made a very strong push to the upside, breaking above that pre-market high and creating a fair value gap from here to here. Now, again, we don't want to just blindly buy because price is coming into that fair value gap. We want to use that 8 EMA and the Fibonacci retracements to give us a more direct area to watch inside of that fair value gap. So as we see, price comes in, hits that 8 EMA, pretty much hits that 50% retracement. And again, if you broke it down to a smaller time frame, you could have identified a sniper entry to get in before this big move right here, and then caught that entire move to the upside. So let's just say that you ended up going long a little higher once you noticed that reaction. Let's just say you went long there. You have two different ways that you could place your stop loss. Again, below the fair value gap because it's so small, and also you have that pre-market high there as well. Or you could just keep it below the 8 EMA. It's just going to be a tighter stop. But overall, based off of this move right here, you could have potentially captured a 2.88R trade. Again, meaning you were risking $1 to make $2.88. So your stop loss was around 2 to 3 points, and you captured around 5.75 to 6 points on this trade. But like I said, this strategy is easily becoming one of my favorites to trade, and it has a very high accuracy rate. So as always, if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video.